All right, today we're going to break down a really fascinating company, one that honestly operates more like a finely tuned machine than your typical corporation. We are talking about the Swedish industrial giant, Indutrade. So, if you're an investor, this is the big question, right? When the whole economy feels like it's stuck in mud, where on earth do you find companies that can still reliably grow? It's tough. Well, instead of chasing, the latest flashy tech trend, we're going to explore a totally different model for growth. This is all about a company that basically acts as a permanent, safe home for fantastic under-the-radar businesses.
Okay, let's really get into it. We're going to unpack exactly how Industrade has built what a lot of people consider a true compounding machine, something that just consistently creates value year after year.
So, how does this machine actually run? Well, it's got this simple but really powerful two-stroke engine they call buy and build. Let's take a look under the hood. At the heart of it all is what they call the Indutrade way. Now, the idea is pretty simple. They own this huge constellation of over 200 specialized companies. But, and this is the key, they let them run themselves. It's all about keeping that entrepreneurial fire alive that made them so successful to begin with. And this lays it out perfectly. So step one, they go out and buy 100% of a great little company. Step two, they add value from the mothership, things like financial muscle and sophisticated business tools. But step three, that's the real secret sauce. They leave the culture, the brand, and the management team completely alone to just keep doing what they do best. And look, this isn't just some fluffy marketing slogan. This is a massive competitive advantage. I mean, think about it. If you're competing with a private equity firm that's probably going to load your company with debt and flip it in 5 years, well, being known as the permanent supportive owner, that gets you into deals that nobody else can touch. Entrepreneurs sell to Indutrade because they know their life's work is safe. And what you end up with is this incredibly diverse portfolio. You can see from their new structure for 2024, no single industry has too much power. This is diversification by design. It's like building a structural defense wall to protect the whole group if any one sector has a bad year. Okay, so the model sounds great in theory, but has the machine actually been churning out results? Let's check out the track record and see the proof. I mean, the numbers really do speak for themselves. This first bar here shows an average sales growth of 12% a year, every year since they went public back in 2005. The second one shows a 14.6% average profit margin over the last 5 years, which is comfortably above their own target. This is the definition of consistent, reliable output. But hold on a second. For a company whose entire growth strategy is buying other companies, sales and margins don't tell the whole story. The real question, the one that separates the good from the truly great, is whether those acquisitions are actually creating real value. And here it is. This is probably the single most important number in this entire explainer, a 21% average return on capital employed over the last 5 years. This is so crucial because it proves Indutrade isn't just buying growth for the sake of it. No, they are allocating capital at exceptionally high value-creating rates. That right there is the hallmark of a true quality compounder. But, no company has a perfectly smooth ride. Every great machine gets stress tested. And for Indutrade, that big test came in 2024 and 2025 when the global industrial economy really hit the brakes. So how did the machine hold up under pressure? This timeline tells the story perfectly. In the second quarter of 2025, you see they hit the bottom. Organic sales fell 4%. But just 1 quarter later, that decline had already slowed to just 1%. Now, the most important number here is the last one, order intake, which is a forward-looking number. It actually grew by 3%. That was the first little green shoot signaling a recovery was on the way. But here's the thing. The slowdown wasn't happening everywhere. And this is where that diversification we talked about earlier really shines. While the more cyclical parts of the business, like construction, were weak, the more resilient areas, like process and energy, and especially life science, they were stable or even growing. They acted like a huge shock absorber for the whole company. And check out how they managed this. It was just brilliant. This wasn't some clumsy top-down order from headquarters to slash costs everywhere. Because of their decentralized model, the individual companies seen fall in demand were able to trim their staff by 6%. But at the exact same time, the companies that were still growing increased their staff by 2%. They were surgically cutting the fat while still feeding the muscle. It was so smart. And the result of that surgical approach? An incredibly strong 14.6% profit margin in that third quarter, right at the peak of the slowdown. Think about that. Even with sales going down, the machine's pricing power and its cost discipline allowed it to totally protect its profitability. That is what resilience looks like. Okay, so the machine proved it can handle a storm. Let's bring this all together now and look at the investment case as it stands today.
First things first, let's talk price. Back in the hype of 2021, the stock was trading at a peak of over 33 times its earnings. As you can see, that multiple has come way down. Today, it's closer to 20 times, which is well below its 5-year average. That suggests the market has already priced in that whole slowdown we just talked about.
And look what happens when you put it side by side with its closest Swedish peers, other high-quality cereal acquirers like Latour and Lifco. Indutrade is now trading at a pretty noticeable discount. It kind of feels like the market is punishing it for a cyclical dip that might already be over. On top of all that, the balance sheet is basically a fortress. With debt at just 1.4 times earnings, Indutrade has a massive amount of dry powder. And that's not just a safety net, it's an offensive weapon. It allows them to keep buying great companies, while other, more indebted competitors are stuck on the sidelines.
So, it all really boils down to this central debate for any investor. The bulls see a best-in-class company that has absolutely proven its resilience, is already showing signs of a recovery, and is trading at a discount. The bears, on the other hand, they worry that organic growth might be stuck in low gear and that there's just too much competition for good acquisitions these days. Which brings us to our final thought. We've seen the machine get put through a serious stress test, and it passed with flying colors. We've seen its price tag come down to a much more attractive level. So the question now for you as an investor is this. Does that combination present the perfect opportunity to invest in this Swedish compounding machine for the long haul?